Well, thank you everybody for coming out. My name is Zachary and this is Jaime, and today we're here representing the banking sector. We created a model today to help and present to y'all that'll give you some factors to use. That's how we chose we have one buy strategy we're going to present today. So first of all, we're going to start out with a market outlook for the banking industry as a whole. Then we're going to move into the model section and give you an overlook of what we did for our model, what metrics we used to create it, and how we feel that those metrics can help evaluate and give a meaningful insight into a buy strategy. Then we're going to go into emerging technologies for a company that we chose that we believe we're going to sustain in the future, and then we're going to conclude with a thank you and a quick analysis over what we've given today. So we're going to start off with market outlook. So the banking sector is really controversial right now. In the next 10 years, we see a lot of differences that might occur within the industry. Analysts on both sides are giving outtakes of a recession for this period or next year. Other people are saying that it's going to remain stationary. Other people are recommending that it's actually a great time to buy into it. But what I really love today is that the banking industry has in fact become bigger. In fact, it's not only bigger and more profitable, it's also more resilient than any time it has been in the past. Total assets in the industry are actually totaling $124 trillion as of 2018. So it's given that it's really strong right now. But recovery hasn't been uniform, also remember. So for domestic banks, it's been a lot faster for the healing process from the financial crisis. Unfortunately for European banks, the growth seems to be a lot slower due to several factors. But what we believe has in fact propelled the domestic banks to recover a lot faster is the growth of things like the Dodd-Frank Act, a lot of regulatory measures and prevention, favorable GDP, tax cuts, and other factors that help propel banks out of the financial crisis. Fortunately, the banking in Europe isn't as fortunate. So the region still has a lot of deficiencies. There's no regulatory agency for the pan-European banks to rely on. It doesn't have, it's likely, we've seen companies like Deutsche Bank that have gone under, that have had really low or negative interest rates in the past, that we believe ties to the performance of these kinds of banks. And they just don't have an international outlook anymore, in my opinion. They're attracting. I mean, they're almost 1/4 of what they had money put into international markets now. We see we had $60 billion in 2017 put into from the top 5 banks, and now it's $17.5 billion from 2017. But the European banks are showing some improvement, we believe. Their ROE from the Western banks has grown. It's increased from about 8.6%, 8.8% from 2017, 2018 here from the past, given that 5.5% from earlier 2017, 2016. So there may be some hope for European banks to recover. It'll definitely be interesting with companies like Deutsche Bank and investing in things like European bonds. Also, the emergence of Brexit has caused United Kingdom to have some controversial factors in the banking industry and certain financial services. So there's a lot of skepticism still in the industry, I believe, from what we're going to see in that kind of growth. Asia Pacific region. So Asia is a really interesting character in the past 10 years. In fact, Asia has the top 4 banks in the world right now, the top 1,000. The ROE is about 15% right now, covering the top 4, which is fantastic. The only skepticism we have is that the growth will slow with tariff wars occurring in the United States and different economic news coming out. Obviously, the trade wars within America have caused a lot of skepticism in the banking sector. China has some really interesting growth in technology, though. We think that there's going to be an interesting insight into that and how they're going to play out in the next 5 or 10 years, given that their growth may stagnate and far off from the 10%, 10-15% it's been experiencing recently. Japan really hasn't changed much at all, in my opinion. Not only did they really not feel a devastating effect from the financial crisis, but they don't seem to have a lot of growth because of stagnation within their low or stagnating interest rates and low GDP growth. So that's the insight for Asia Pacific. And we did have a graph showing real GDP in that region. This is our outlook. It's kind of, I'd say this is a conservative estimate. I'd say that GDP growth is more conservative estimate in this graph here that we're going to show. But definitely, it'll be interesting insight. I think Asia will be a place to watch. Emerging markets will be an interesting factor considering that China is in MSCI now. So, what do we think about it? Well, despite optimistic picture, the GDP forecast by IMF or International Monetary are not so bright. So there's been talk of a recession in the United States, 2019, 2020. Goldman, JP as analysts giving predictions on that. But if we do have some kind of recession, it could really weaken economic growth in the United States, which could really afford the dilutions and tariffs of the stimulus package could really have a devastating effect in the economy. Technology, we're seeing a lot of things innovate in the industry, like blockchain, like what's occurring in one of the companies we're going to review today. But we're also looking at things like artificial intelligence and cloud computing services that could be beneficial for the industry, that could be really changing how people bank, how customer services are taken in particular, and commercial banking as a whole. So for today, we're going to give a market outlook of just market reform, a hold strategy. We don't think you should necessarily load the boat right now, but we don't think you should drop ship either. We're just going to have a solid hold strategy and see what news is going to come out before we get out of banking services. So now we're going to get to the model part. We created a model here with mid cap and large cap banks, and we're going to present the different metrics that go into that and how we're going to factor that into our price to book ratio, which is our independent given our dependence. So we got a 76% correlation on this one. We think it's pretty accurate. We had higher correlations, we had lower correlations. We like the metrics we put into this one, so we're going to go ahead and present this one and give you a rundown of how it works.
Hello guys. So here is our model, right? So for this model we broke it down in big cap banks and also mid cap banks. And the reason why we broke it down in mid cap and big cap is because so in America the four biggest banks they weigh like most of the market share, right? So whenever we were trying to have a correlation with all the stocks in only one model, our correlation was very low. So that's why we decided to break it down in two. So that's why we had the same correlation in the big cap and the mid cap, okay? So the metrics that we use, the independent variables or EDs, are growth, profitability ratios, efficiency ratio, return on invested capital ratios, and risk ratios. So for growth, we use growth in total loan and growth in total deposits, because these are like the main things how banks make money, because banks we take in deposits and then they lend the money at a higher interest rate, okay? And for profitability ratios, we use return on assets, return on common equity, operating margin, profit margin, and weighted average cost of capital, economic value added spread. So all the key profitability metrics is the return on common equity, because in the return on common equity is how investors see how much the amount of the company income is returned to the shareholders' equity, right? And also the weighted average cost of capital is a measure of the value a company generates from funds invested into it. Okay, and one of the key metrics is the efficiency ratio. Why? Because the efficiency ratio is calculated by divided the bank net interest expense by net income, and always banks strive for a low efficiency ratio, since a lower efficiency ratio means that the banks are earning more than they're spending. Okay, and for the return on invested capital ratios, these ratios are used to assess a company efficiency at allocating capital to generate returns. And then for the risk metrics, we use the implied credit default swap spread and then we use the Bloomberg what is this? The Bloomberg default rate for 5 years, 3 years, and 2 years, and also the total debt to total equity. And then our dependent variable, or Y, is the price-to ratio, which is the value which measures the market value of the company to its book value. So here we had the weight, the ranking. So here what we did is that we use Solver to help us have a better, more accurate weight measure, and we use the sum product formula. So we divided the weights by the ranks in order to get this number. And in this rank, the lower is the better, because it means that the company is performing well in all the metrics. And then here, our correlation was between the weighted rank intrinsic and the price-to ratio, which gave us a 17% correlation. And after that, I mean, here JP Morgan, right? So here, you can see that our model is pretty accurate, because whenever we compare the price-to ratio, and then whenever we re-rank the weighted rank, right here, the variance is 0. So it means it's a whole. So it means that the model is accurate. But here, we were looking for banks with, so our criteria for buy was banks that were in the top 5 re-rank with -2 variance or more, right? So here, our buy recommendation were US Bancorp, MT Bancorp, and Signature Bank. And then, so after doing analysis on these 3 banks, we decided to go for Signature Bank, New York. And then now, he's gonna explain, he's gonna show the company now.
Okay. So, good job. Oops. Going back. All right, so today we have a buy strategy for Signature Bank, New York, ticker SBNY, US Equity. It's a full-service commercial bank based in New York, spans 5 bureaus in New York, also Connecticut, and just recently a branch opened up in California last year. So they're a full-service commercial bank. They mostly meet the needs of private businesses, senior managers, and their owners. They have a strategy mainly of addressing a group of clientele that they believe has been underserved in the larger financial institutions that reside in New York. So they help them with all kinds of financial planning services, products, their brokerage service as well, so they help in that aspect. So they were founded in 2001, and then we're going to go over the management of the company. So their CEO, Joseph DePaulo, is here, pictured, and you also have John Tamberlane, who's the director, Mark Zagona, who's Chief Operating Officer, Vito Suska, who's Chief Financial Officer, and Michael Starkey, who is your Chief Technology Officer. What we found interesting about the financials of the company was they experienced a dividend rate of 2.24. The actual, let's do a slide. Oh, I can't enhance that. Okay, interesting. They have a dividend rate of 2.24, which I found was normal within most banking institutions in New York, at least. Look at the financials; look great. Also, to go to. But what stood out from this bank from others was the market cap was significantly lower than other banks like Bank of America and JP Morgan. They only have about $7 billion values, which is significantly lower, not even a tenth of other banks. So it really stood out. It's a different outlier from most models. But their CFO CapEx really stood out in their financials, 56.72. We believe with this ratio there'd be they have a strong possibility of acquiring long-term assets using their free cash flows. So it should be a really good basis to acquire new assets for the company. So breaking down their ownership, also realize that most of their ownership is through through investment advisors. BlackRock is actually the top market share of this company. They have about 5.2 million shares, with Vanguard leading right behind them with about 4.7 million. Hedge managers ranked at 11% ownership, pension funds were 7%, and an individual was only about 2.5%. Now, the insider information we could draw from this company was interesting, to say the least. Insiders hold about 2.5% of outstanding shares. We only found about 16 insiders that were actually listed for the company. So hopefully that helps with dilution and other kinds of problems that could occur. This is just a chart giving an overview of the ownership of the company. BlackRock is top here. They have about 5.2, Vanguard, right below T. Rowe Price, another investment group. And going into their gap, I was going to use their balance sheet, but I ended up using the gap highlights. I thought it was a more interesting view of it. So their interest income is normal for a bank. It's been growing, considering that the bank was founded in 2001, which is fairly new. Their assets under management is fairly low compared to other established banks. But their interest income doesn't seem to have a problem growing. It has an interesting, in fact, they reported about 1,300 million last year. So, given that they have non-interest income, most of their interest is gained. Well, actually, almost in their entire business model is gained through interest on loans. So that seems to make sense. Their net revenue seemed fine. Given that their basic EPS looked healthy for the most part, rather diluted, looks a little strange. But their total loans have been growing, which is good. It kind of strengthens that CapEx assumption I had earlier, given that they do have expenditures within the company, and they are giving out loans, so it seems to be pretty healthy. Their earning assets look good. They've also been growing fairly constantly along with loans. Their debt, their liabilities somehow, their liabilities, if I remember, were increased. Yeah, had a really high difference in 2017. We believe this is due to financing or issuing more common stock. I believe that's the only reason I can find that number be so significant in the last graph pulled up. Cash for operations look really healthy, and their investing activities are slightly stagnating, but we believe that the reason they're stagnating is kind of because they just aren't really buying any more fixed assets equipment, we believe, since they're a little more established. Other than the California branch opening up in 2018, we don't see new purchases like that. So this is just showing the market cap. It is small, but significantly greater than the past 5 years. The book value is increasing. It's increasing actually I think it was about 7.4% a year was their show. Deposit ratio looks really healthy. Growing, but probably slightly decreasing because of the state of the financial industry right now. People are looking at less deposit ratios. People are not increasing their deposit ratios nearly as much as they were prior to like 2013 to 2014. But it is growing slightly, as long as the U.S. does have some kind of realistic economic growth. Oh, I'm sorry, yeah, I meant to go this. And their Tier 1 common equity looks healthy. Their Tier 1 is adjusted is comprised of their reserved equity, so it looks really healthy to me. And their capital rate looks fine as well. So I'm going to go into, I'm going to have it behind me, and he's going to go to the emerging technology section, which is one of the aspects of why we chose this bank. I believe it is a great buy strategy because of the technology it's implementing into its service.
All right, so whenever we started the semester, we're looking for a bank that invested in financial technology, because nowadays, it's where the future, all the important banks are trying to have digital payment apps, to be more efficient. Okay, so actually, Signature Bank just launched Signet, which is the first digital payment backed by the blockchain. Okay, it's the first bank that is gonna use the blockchain for their payments. It's actually it's powered by the Ethereum, and it's gonna let clients put money in 30 seconds, 24/7, in no fees. But the minimum requirement is $250,000 because mostly of the clients of Signature Bank are like big clients, so that's why right now they're moving like millions, but instantly with this application. Okay, so because traditional corporate using the automated clearinghouse, they can take as long as 3 days, and usually they're not available during the weekends, which may cause failure in like lost businesses. Okay, and also while this implementation of blockchain is limited to only signature bank members, it is also a part of a larger plan that could eventually see the bank directly connecting to others without the need of an intermediary. And actually, among the list of clients using this is the American PowerNet. Okay, the American PowerNet is an independent power supply company providing retail and wholesale electric supply. And the company uses Signet, which means it's the first is the first blockchain transaction backed adopted by a renewable energy company regarding power payments. So I think this is very important because this is also benefit. It's gonna also other industries are gonna benefit because in this case, these companies using this app for their customers to pay for like the energy customers to pay through this app. So that way, it's gonna become more efficient. It's gonna benefit more industries in the future. So I think this is one of the biggest reasons why we decided to choose this bank because, like I said, it's gonna benefit other industries as a whole.
Oh, let me try it. Yeah. So the new blockchain technology that they're using is going to be based off the Ethereum token, an object-oriented token already given. So essentially, it'll be a person-to-person transaction secured by cryptography. I'm sorry. Given so that they can send money 24/7, peer-to-peer network without the exchange of the intermediary at the bank. So it'll be an interesting insight into what's going to happen in the future of interaction with artificial intelligence and the cloud computing in the banking industry. So that wraps up our presentation. Thanks for listening, as always. And if you have any questions or comments, feel free to ask us. We do. Sure.
You did a pretty comprehensive presentation, but if you had more time, I know you're time constrained. What other things might you have done?
So essentially what I would have done, if I went back to financial analysis, I definitely would have tried to make some kind of, I would have tried to make some kind of actual, I'm trying to say, what's the template you use for the Bloomberg item? Forget it. It's I'm sorry, an actual formalized report on the differences within the industry, especially competitors. Like I would try to say, like take it like a local credit union versus a larger institution like JP Morgan or Goldman, which is actually more investment banking services. But let's take like Bank of America, right, and get their metrics on, get their data on what their actual earnings are for the year. And probably the insights in the first quarter earnings. I know the first quarter report came out in I think it was it 10 days ago? Yeah, 10 days ago for this company. And they experienced a little less, they experienced less optimism than they did from late 2018 perspective into what's gonna happen to the industry. Okay. So I'd love to see what a larger institution would do. Okay. Anything else, what would you do different?
Did you want to answer that? Anything you would do different?
Probably have more like probably have more content in my model because I only show the screening part, like the ranking, but we didn't show more graphics, showing the different metrics, but in a graph. So I think that would have been good, and also Yeah, I think for the model, I think that was a little better.
Okay. I know Bloomberg has a lot of metrics that are specific to banks, you know. I think the ones that I saw you use were loans and deposits that were specific to the banking sector.
Yeah.
What made you not want to use some of the other ones that were specific to banks, such as net interest margin?
Okay, because whenever I was running first I ran a regression model, so I was having like a negative slope with those metrics. So and then when I implemented these metrics, the correlation went higher. So
Okay.
that's the reason why I decided to put all these metrics specific, to
And
have a
then-
higher correlation in my model.
And then just to follow up on the correlation part, one of you said that there was a model that had a higher correlation, but you chose this one. And like it's
Included it's the whole, but the actual metrics used were actually relevant to like the industry. So I think instead of using like we have return on invested capital, we have total return assets. We had it was I know we included the credit spread. I'm sorry, the credit.
Credit spread.
It was swaps.
Yeah,
it was swaps metrics into it. It just gave us it didn't give us a good insight into what actually we wanted to view from the banking unit sector. They were kind of irrelevant. They're kind of general. I think it was
Sales.
it was a return on. It was sales. Well, sales was one. Sales was one that we give. Maybe it was just sales. So we didn't believe that actually had a real correlation to what we wanted to find within the industry.
okay.
All right. Good job, Brad.
Yeah,
Good job.
thanks. Good job.